Asana has been one of those companies that's had a ton of potential for years, but has never been able to actually turn its business around. They generate really great growth, really great profit margins, but their costs are just absolutely out of control. And that's what the market has been criticizing by pushing the stock over the last few years. It was a hot stock during the pandemic, and then obviously shares crashed. But last week, the company released earnings, and the stock is up about 65% since then. So is this a real turnaround for Asana, or is this kind of smoke and mirrors? I want to go through exactly what's happening fundamentally and try to put a little bit of a sober view on this. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content, and thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. I'll just start here with the stock reaction, 64.3% as I'm recording on Monday over the past week. Just a phenomenal jump here. This was after earnings was reported. But let's go through some of the things on this earnings report because it's similar to trends to what we've seen before. Also put up some charts that hopefully put this into a little bit more historical context. So revenue for the quarter up 10% to $183.9 million. Still nice to see that Asana is growing the business, but still reporting an operating loss of $60.2 million or 33% of revenue. Now, this is where you can just look at Asana on the surface and say that is absolutely crazy that they're losing that much money. But then you get to the fact that Asana expects to be cash flow positive. You look at their cash flow, even just in the most recent quarter, operating activities negative $14.9 million. So that's a lot lower than their operating loss. But you can see here that they start at the top with on track to deliver positive free cash flow in Q4. Revenue is expected to be up slightly in the quarter, up about 10% year over year, and non-GAAP operating losses, $5.5 to $6.5 million. So how do you square all those things? The first thing to look at with Asana, beyond revenue growth, in this top section, the revenues, cost of revenues, and gross profit, always really impressive for Asana. They have very, very high gross margins. That has always been the case for the company. So that's not really a concern. What's always been a bigger concern is these operating expenses. So what is the trajectory of those? We're growing revenue at about 10% at this point. So over the past year, R&D expenses are up 2.8%. Sales and marketing expenses are up 6.5%. And general and administrative expenses are up 5.1%. So those things are at least not growing as quickly as revenue is. That's a positive sign, but we're still seeing these huge losses. And these losses are only getting slightly better. You see $63.4 million in operating losses a year ago, now $60.2 million. So at that pace, it would take a very, very long time to get to some sort of operating profit. So what's going on here? This is the cash flow statement. And this is where you want to look to see exactly how these operating metrics move to potentially positive free cash flow. How in the world do you get there? Well, you start with a net loss. So that's what the company is reporting. And then you add back all of these non-cash expenses or expenses that are maybe not reflected on the income statement the way that they should when you're looking at cash flow. So the biggest item here, and this eats up almost all of the loss, is stock-based compensation. In the most recent quarter, they gave out $52 million in stock-based compensation. Over the first 9 months of this year, $160.7 million of stock-based compensation. This is diluting shareholders. Everything else you see here is pretty normal. Don't like to see that deferred revenue is coming down, so that's something to keep an eye on, but not a real big surprise, any of these other items in the cash flow statement. The big thing is just this massive, massive stock-based compensation number. And one of the reasons that's important is because look at this down here. How is management keeping this from being massively dilutive? They're just buying back stock. Over the past 3 months, $54.8 million of stock repurchases. So yes, you're not technically spending that money on employees because you're giving them stock, which is in a cash payment, but you are spending that cash to buy back shares of stock. So the full story is that the company is still losing a ton of money. It's just kind of hiding it in the cash flow statement. Now, cash at the end of the period, we'll go back up here to the balance sheet, almost $200 million worth of cash, another $258 million worth of marketable securities. So the balance sheet looks okay, especially if you're getting to free cash flow positive, but you're going to be diluted year after year after year unless they get these operating costs under control. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. The other thing that Asana announced that obviously the market's excited about is everything AI. Announces AI Studio. This is the no-code builder for designing and deploying AI agents in critical workflows. AI agents are really the new buzzword in technology today. And they say that they're going to be able to allow people to add agents in without any code. So you don't have to be a programmer to be able to do this. Now, they've been talking about this for a while. They're going to be working directly with the team like a teammate, so an AI teammate, if you will. They take on the busy work, handling project coordination, orchestration of critical workflows, from intake to planning, execution, and reporting. So all of these things seem like great value adds for Asana, but they're also the same kind of value adds that other companies are adding in artificial intelligence. So until we actually see this be a driver of future growth and margins, and they said that this is going to be margin accretive, I think we do have to question just how much upside potential there is from Asana. Now, that doesn't mean that the stock can't go significantly higher on speculation here, but these are the kind of things that they've been talking about for quite a while, and there's lots of other companies in this space. So does this have the upside to justify the company's valuation? We'll have to see. Now, the market obviously loves everything artificial intelligence today, especially on the application layer, which is where Asana sits. So it's very possible that this run continues for the stock. What I want to see, though, is that they're actually able to turn this into a profitable business. And that's something that we have not seen yet, is how do they actually generate more revenue and then turn that into operating profit? Because at this point, what management has shown us is that they're just going to keep giving the company away with stock-based compensation. I do want to show a couple of charts to just show the momentum in Asana's performance. This first one is Asana's revenue in the kind of pinkish color, and then free cash flow. And these are trailing 12-month numbers. So you can see that the growth rate has slowed. That's not super unexpected given that Asana has gotten to a little bit bigger size. Free cash flow has gotten better, at least since 2022. But look at this chart with the company's shares outstanding, and you can see that that growth has just been absolutely crazy. The number of shares outstanding has tripled since 2020. Now, obviously, that was when the company went public, but even since the company went public at the end of 2021, fiscal 2021, you had 106 million shares outstanding. Now we're at more than double that. And it doesn't seem like Dustin Moskovitz, who is the CEO, largest shareholder, and has actually the most interest in the stock price going up, really cares about not giving out more stock as compensation. So a little bit strange the way that the company is run. That's what fundamentally is keeping me out of Asana right now. I want to really like this company and the stock, but it just doesn't seem to be run very well and very successfully. And over time, that has not been a successful way to invest in technology companies. Buying money-losing companies doesn't typically translate into profit over time. You want to have companies that are making money and we're making money early in their life cycle, because that growth and that ability to generate growth profitably just compounds over time. So we're not seeing that with Asana, but I'm definitely intrigued with what they're doing in artificial intelligence and with their product lineup. Definitely have momentum in certain segments, but until they turn around those operating margins and the actual operating margins, including stock-based compensation, not a stock I'm going to be buying. But let me know what you think about Asana today. Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.